What is going on, everybody? Paul here, coming at you with another Crypto Coffee update where we talk about the exciting and seemingly ever-growing financial technology space that is colloquially known as crypto. Before we jump into that, please join me for our customary simultaneous sip where we just enjoy some water, tea, or in my case, coffee, just to get our episode and day started off right together in solidarity with a tasty beverage. So, join me. Good stuff. All right, let's go ahead and explore what we have open in front of us today, which is CryptideCast, our website. I like to start off each episode with a very short tour, showing that you can get up to date on all of the Crypto Coffee updates and more in the video section. Stay up to date on news, since after all, digesting an entire Crypto Coffee update may not be preferable for everyone's schedule, so you can kind of get snippets and little bite-sized pieces to digest about what's going on in the crypto space as a whole throughout your day. And we have the blog section, which has next week's crypto and can let you know about conferences and events happening in your local region and perhaps local area that you can attend if you so desire. So, with that said, Cryptide.cc, check us out, and let's go on to your feature presentation, which starting out is a humorous article from Rebecca Layton, actually more of a comic than an article, with an individual asking a bankster, hey, will my Bitcoin be safe in this vault? It's kind of a tongue-in-cheek, humorous take on the fact that Bitcoin specifically lets you be your own bank, which is a statement that has a lot of implications wrapped up in it. I don't think breaking down such a statement in its entirety is objectively possible due to some of the subjective meaning this has to individuals on a case-by-case basis. However, with that said, I believe there are some more objective implications that we can draw out of this humorous take on such a state of affairs and kind of bring that to the forefront for your interests. One of the most important things I think we can draw out of this is the differentiation between Bitcoin versus the traditional banking and financial system. So Bitcoin is what's known as a push system. So a push system is different than a pull system. This is extremely important and while seemingly simple, has some huge implications. We won't go into all of them, but nonetheless, just to help illustrate the difference between Bitcoin and a traditional financial system, let's take a look at this wonderful article that of course will be linked below in the description so you too can digest it as you see fit. Now, this is how Bitcoin specifically and most other cryptocurrencies function. The consumer is able to push value from their Bitcoin wallet to another individual or merchant's Bitcoin wallet. It's simple. All you got to do is push it off and you are the arbiter of that action. They can't pull Bitcoin out of your wallet. Now, there are some technicalities that may invalidate this, such as what's called a multi-signature Bitcoin wallet, which requires two individual signatures from perhaps two separate wallets or two individuals, two private keys. But for the sake of brevity and complication, we will simply envision Bitcoin as a push system, which it by and large is. Now we have the pull system, which is our traditional financial network. Individuals may think that they are pushing value to a merchant when they swipe their credit card and enter in a PIN. However, they are simply giving permission to the individual to go through a technological sequence of events that in turn pulls the money out of the end user's account. So what this means is that there's huge implications for what vectors of attack may or may not be viable in such a system, how such a system is exploitable, and not only that, to what degree the individual consumer has efficacy over how his or her funds are managed or controlled. So with that said, again, huge implications that I'm sure if you let your mind run wild, you can envision some implications that we don't cover here, but for the sake of brevity, share this below in the description, and we'll move on to another fantastic article that I thought was a great return to basics. After all, there are new users entering into the crypto space all of the time, and it's easy to get caught up in some of the more heady implications and ideas about Bitcoin and crypto as a whole. Now, this is an article written by Connor and seemed to be partnered with Changelly, so I wanted to give a shout out to both of those, individual and entity, to let them know that they're doing a good job, and after all, keeping new users in the loop and making sure they have access to information like this so they can start off in a safe, secure, and really just fantastic manner is it's central and it's critical. After all, there's no big dampener like losing, let's say, 100 or worse, even more dollars when trying to purchase Bitcoin. You don't know where it went. You don't know what happened. Maybe you didn't back up your private keys and you're not sure what exchange to use. There's plenty of questions that can be had. So with that said, wanted to share this with you guys. We're not going to go over everything in incredible detail. We're just going to kind of skim through this, and you can share it with individuals, friends, and family who you believe maybe needs a helping hand with getting started with cryptocurrency right. So with that said, can withdrawing funds ever be an issue? Absolutely. Again, this is something we discussed in our push versus pull system. If you push your funds to an exchange, then you are essentially saying that this exchange is the custodian of your cryptocurrency and will credit your account to reflect the amount you sent accordingly. So I know that's a lot to digest there, but essentially what it means is you cannot pull your funds back off of the exchange. You have to request them, and the exchange in turn has to push your funds. So in the event of insolvency, you can see that Mt. Gox is in turn referenced in this piece. It's difficult to get your funds back if the exchange or the entity says no dice. So there is a bit of intrinsic risk associated with sending your funds to a centralized party, but again, businesses need to make money, and generally they're more than happy to assist you, which happens to be our second point here. What happens if I send my coin to the wrong address? Policies will vary depending on the exchange you're using. After all, these are centralized third parties, and while there is an element of implicit and explicit trust involved, many of these entities are businesses and they have a reputation that they wish to uphold. So with that said, there are some safeguards in place when using centralized third parties that will more than likely be willing to help you depending on the scope and the size of your problem or issue. With that said, in a peer-to-peer transaction, there is a bit more risk, and if you do not know the owner of the address to which you sent your crypto or your Bitcoin, whichever, it's ultimately not very likely you will see that again. So it's very important to check not only both the amount that you are sending is correct, but also that the address to which you are sending that amount is ironclad and looks exactly like the receiving address, or the receiving address that you are inputting. So with that said, number 3, could my transaction be left unconfirmed? Yes, but it's not very likely. Really depends on the average price of sending over the particular network. For this sake, we'll use Bitcoin. Back in 2017, Bitcoin's prices skyrocketed. The blockchain had what's called bloat, or more transactions being requested than the blockchain could handle at the time, which means that the only way to prioritize various transactions was a elevation in the actual fee to send said transaction over the Bitcoin network. So while yes, the transaction could be left unconfirmed, it's very unlikely that this transaction will be left unconfirmed in perpetuity or just on the blockchain forever, kind of in limbo. It'll either be rejected after a certain amount of time, depending on what service you're using, or it'll essentially just kind of confirm whenever it's included in a block from the mempool. So with that said, possible, but very unlikely. What happens if I forget destination tags or memos? This is largely will depend on what type of wallet you're using, but some do accept transactions even though this data is absent. So again, technical point. We'll speed up here to go ahead and get to the other material that we have. How can I recover my crypto if I end up in an orphan block? Although valid and verified, orphan blocks are not accepted into a network after suffering a time log, leaving them in isolation. And if I sent the transaction with a tiny fee, what do? Relax, there's plenty of options. As said, some places let you adjust the fee. Over time, it may just bounce back into your wallet. So there's many options here. And again, just as Cointelegraph is offering a disclaimer, none of this is financial advice, just some interesting information I wanted to share with you guys so you too can share it with individuals who may need a helping hand to get started right in this exciting space that is crypto. All right, so for you veterans out there who are interested in the news, let's go ahead and get into the actual meat of the matter for the day. Some very interesting developments. Some team members are apparently leaving the Haven protocol. I thought that would make it larger. But here's the really tiny Discord message from some of the team members saying that essentially they haven't heard from devs in over 3 months, not looking too good in that regard, and yeah, they're really unhappy, so they're moving on from the project. One even went ahead and called it dead, said yeah, this is dead, not happening anymore, haven't heard from the devs. So that caused a lot of worry. Again, this is Haven Protocol, and it seems as though it had a bit of a happy ending, if you call it a happy ending. Essentially, Haven Protocol is a fork of Monero that seeks to use Ring CT, along with other obfuscation mechanisms, to create a cryptocurrency that allows for plausible deniability in payments, meaning that, hey, I didn't send the payment, somebody else did, and so it's generally used for privacy-centric activities. So, with that said, here's the happy ending, if you could call it that. Essentially, both of the co-founders were quick to turn up alive and kicking. One of the lead devs said, oh yeah, this was controversial, and talking about how there was a lack of transparency, so at least he's accepting some of the responsibility there. And another co-founder said that he's going to go ahead and share control with the rest of the team, and that they wanted to conceal some of the code for security reasons. I found that particularly interesting, especially in what's supposed to be a open source project. But with that said, taken at face value, it looks as though everything turned up okay, but the implications definitely don't look good. The idea that it's, an exit scam and then the devs show back up, it wouldn't be too out of reason to think there may be some backdoor conversation happening about how to take best advantage of that price action in such an announcement, but that's mostly speculation. There's no ironclad empirical evidence that that did happen, but with that said, I don't think you need empirical evidence per se to say the speculation does not bode well for the perception of the project as a whole. Of course, again, nothing empirical, not asserting that this is definitely what happened, but the optics aren't great, and again, all we have to go on is speculation, but the fact that the speculation may hold water in and of itself means that the optics are poor. So with that said, best of luck to the community and the team as a whole. Nobody wants an exit scam. That makes the space look horrible and definitely leaves investors burned, and it's just wrong. It's unethical. So with that said, glad everything went as good as it possibly could in the wake of the announcement, and it seems that everything was cleared up. But with that said, here's another one. Apollo Currency, which is a fork of NXT, is a scam, according to some Reddit users. And while there's nothing, again, too empirically definitive at this point, we can nonetheless go off of some of the reports that are coming out of individuals who are involved in the community, talking about some suspicious activity that may or may not be valid. Again, it's up to you to draw your own conclusions from this kind of information. We here at Cryptide are just here to figure out what's going on ourselves and share this information with you, and really interpret it to the best of our ability. But we're all human here. With that said, if it walks like a duck and quacks like a duck, it's probably not going to be a bull. So here's some of the messages that are being deleted in the Telegram group for the Apollo currency. Price is up 700% of a week. I might take some profit in case it drops. Why are you banning people for asking legit questions? Followed up with a response from the admin. These questions are just FUD on NXT's tech. These people just want to see the project fail. And this is something I've seen a lot in the crypto space. Individuals who are asking legitimate, hard-hitting questions are labeled as FUDsters, or you're from Project B, and we over here at Project A recognize a Project B member when we see one, and you're just trying to spread FUD. I've said before on this channel, FUD is the new heresy. If you're a heretic, you can be burned at the stake, so be careful not to say anything too heretical. But with that said, it's definitely present here as well. So yeah, a lot of questions and not a lot of answers, definitely a lot of bans going on. And Lior Yaffe, one of the devs of NXT and Ardor, which is the logical development off of NXT. They kind of took NXT's technology and said, hey, after running it for X amount of years, we found out how to improve it, what we need to implement to ultimately expedite the functionality for our end users. And they forked into what's called Ardor. They did an airdrop. So now Ardor is kind of like the new NXT, but NXT's underlying technology as the first stable proof of stake coin is still seemingly pretty ironclad from my perspective. So with that said, Lior did send out a little tweet to Apollo Currency talking about what they could do with reducing block time and whatnot, which can lead to some major issues with orphan blocks, etc. And this is something you see a lot in crypto, individuals wanting to innovate on top of existing technologies and not understanding how augmenting some of these parameters and variables can in turn lead to some unexpected consequences. And if an individual investor is unaware as to some of these implications, ultimately they could be backing a coin that is technologically slated to fail from the outset. So with that said, that's one thing I enjoy about Lior Yaffe. He's very technically minded, very forthright about what he knows and what he doesn't know. So I thought that was pretty cool to bring up as well in reference to the Apollo case. So moving along, we do have a new analysis and an update on the Cryptopia hack we discussed a few Crypto Coffee episodes back. This individual, this Joker looking dude, looks like he's pretty happy with the hack. The original idea, or the original figure that was proposed was around $3 million. Now it looks like it's up to $16 million, so not good at all. Huge amount more, almost over 5 times the amount that was initially proposed, so that's just not good. They took Ethereum and ERC20 tokens. And if you remember, Binance was able to freeze some of these coins as well after some of the stolen tokens from Cryptopia made their way over to Binance. And CZ, CEO of Binance, was able to pull the plug on that and freeze them. Not a lot of information as to what happened afterwards. I'm assumingly they're still working that out. After all, there's a lot of legal implications to this kind of thing. But yeah, the organization was called Elementus, and they did an investigation showing that the hacker has cashed out about $880,000 worth of stolen crypto, and the remaining 15 mil remains in 2 wallets identified as being under the perpetrator's control. So again, they're still out there, still doing their stuff. Authorities are on the case. And yeah, you see the estimations up until now have been between 3 and 13. So this new figure is definitely sky high, not what we want to see. And they have a pretty nice chart showing the assets that were stolen. A lot of Ethereum, a lot of Dentacoin. I can't kind of turn my head to see that. So I guess they needed some dental work done or something, guys. Oyster Pearl, which is a now defunct pyramid scheme sort of crypto thing that was based on IOTA. So they really made out with some weird coins, guys. I don't know why they took what they took. Maybe just whatever they can get their hands on. But yeah, interesting stuff. And you can see the second largest share is other. So there's probably a plethora of various digital assets they were able to get their hands on. So we also have crypto exchanges admitting that it is a difficult time. Here's Huobi talking about how during the crypto winter that the largest amount of capital they have coming in is from transaction fees, and that they don't know how long the bear market will last, and they're really needing to spend their money carefully to ensure that they're able to maintain the quality that they're known for, while also ensuring that they're able to expand operations sufficiently for assumingly the next bull run at some point. After all, that is a piece of the puzzle that caught a lot of exchanges off guard. They weren't able to process user requests efficiently. Some individuals over my way, Bitrex, were saying that it took up to 6 months to have their accounts re-verified. So they really just had either crypto sitting on this exchange, unable to be moved around for 6 months during a bull run, ouch, or they just couldn't do any trading activity at all using a reputable exchange, just simply due to the volume of inflows and requests for Bitrex specifically. And that's just one US-based exchange. This is the time when Binance really rose to new heights and became the #1 crypto exchange in the world. So this is kind of a tenuous situation where they have enough capital to maintain day-to-day operations, but not too much freed up capital for investments, and especially speculative investments, such as new user features that may or may not in turn result in more actualized revenue flows. So definitely something that is interesting to observe, and this is a really trying time for so many entities in the space. And this is really when entities, they show whether they can do or die. And it's a fantastic time for growth, for building, for learning. And I honestly really enjoy bear markets for that reason. Let me know what you think, though, below in the comments. If you're a fan of bear markets, if you think there's some benefit that can be had in these trying financial times. But nonetheless, interesting. Speaking of Korea crypto exchange executives faked their trading volumes and they got prison sentences. So this is something that I've mentioned previously that Cryptide is keeping a close eye on, because after all, if you're not sure whether or not the volume that you are observing is legitimate, that can lead to some huge implications, especially if you're a larger investor or a whale, as they're called here in the space, individuals with huge amounts of capital. They could maybe see an arbitrage opportunity that looks beneficial for them, or they could just simply think an exchange is more reputable due to the amount of volume, when in all reality, it's simply wash trading. This is something that traditional financial markets are generally quite good about in terms of catching and stopping before it even starts. However, being a young space, the cryptocurrency scene has not yet adopted to these principles and tactics to help to curb false volume in an effort to draw more eyes to a particular entity. So with that said, there are plenty of institutions and entities that are coming out now hoping to solve such an issue, and it's really fascinating to watch. But suffice to say, fake accounts and false orders, nothing too particularly new there. I think we all know how that works. But with that said, it is indeed Upbit. And officials at Upbit, one of the largest exchanges in South Korea, were charged with similar fraudulent activities, according to the report. 3 officials of the company, including the board chairman and finance director, faked orders to the tune of $260 billion. That's a lot of fake volume. So really, with that caliber of false volume, it's difficult to discern what is real and what is fake in this space. So we'll leave it at that and move on to a BOE, or Bank of England, senior advisor over at Davos, saying that, hey, cryptocurrencies are a threat, but he's not too worried. I just thought it was an interesting statement, since after all, just even 3 years ago, 5 years ago, if you were to bring up Bitcoin or crypto, most of the individuals by far at Davos would say, what is that? I've never heard of that. Oh, it's a new digital asset thing, cool. Or maybe if they're more abreast to this kind of information, they may say something like, oh yeah, I've heard of that, looks interesting, don't think it's going anywhere anytime soon, who knows. But with that said, now it seems that the consensus is very much, not only, yeah, we know what Bitcoin is, we find it quite interesting, we're looking at applications using like Hyperledger or the Ethereum network via Amazon's new blockchain implementation, or maybe Microsoft. That may be a response, which is amazing for just a few years, but also individuals saying, yeah, this is not only usable and feasible, but it's a legitimate threat to the existing financial institution, but we're not too worried, of course. That's a huge shift in just half a decade, guys. So just trying to give a scope of time as to how fast this space moves. It may seem like, one day at a time takes forever, but nonetheless, there are definitely things happen in this space, and it's moving more quickly than not. These are individuals who preside over the global economy in many facets, so with their recognition of these digital assets as legitimate, it's going to be amazing to see what the next year or two brings, and exactly when this next bull market kicks off, who knows. But whenever it occurs, I have no doubt in my mind that financial institutions that are huge are going to be wanting a piece of the pie. And NASDAQ CEO calls crypto a tremendous demonstration of genius and creativity. So just an article there to end us off and to help drive home that point in particular, that these financial institutions, as I've said plenty of times on this channel, they're not going away. And while they may not ride in like some kind of fantastic prince on a white horse to whisk the crypto space away into some high castle of valuation, nonetheless, they are keeping an eye on the space just in and of itself. So it's not some kind of salvation for cryptocurrency. Cryptocurrency will be around with or without institutional investment. But keeping in mind that Fidelity has been mining Bitcoin since 2015, it's little wonder that this tepid approach to an exciting new financial technology is beginning to heat up, and once the wheels get turning, it's kind of hard to stop that cart. So with that said, guys, thanks so much for watching. Let me know what you think of this kind of content below in the comments. Truly, it's a pleasure to be able to share this information with you guys. I have a great time doing it. I learned so much from the dialogue we're able to share. Feel free to check out our website, CryptideCast, or join the Discord. Always good conversation going on there. So, with that said, my name is Paul, signing off. Thanks again for watching. We are Cryptide, and remember, the tide is rising, as is clearly the amount of fake volume, but also the amount of institutional interest.